and welcome to the video in which I will take you through the concept of market risk. This video will deal with the concept of market risk which is applicable typically for a bank or financial institution. The focus obviously is on the market risks that banks face. Okay. However, this may also be applicable for different types of financial institutions. Before I explain in detail about the market risk concept, let me tell you the definition of it. Market risk is a price risk associated with trading activities of the bank. So the point that we need to understand is that this risk predominantly arises because of trading activities. It is not something which will arise because of long-term investments. It will arise because of trading activity. Market risk is defined as the risk of losses that a bank may experience, okay, in on and off balance sheet items or positions. So the market risk will be faced both by on balance sheet or off balance sheet positions, and this will arise because of unfavorable movement in the market price. That is what is very important. So this should be noted. These three aspects should be noted by you to understand market risk. Now, market risk arises when banks hold assets and liabilities and derivatives for active trading rather than long-term investments. Okay, so this could be the main reason. Of course, the market risk may arise because of some other factors also in exceptional situations. Okay, but generally this is the main cause of market risk. Having looked at this, we need to understand the books of a bank before we understand in detail the concept of market risk. So when we talk about the books of the bank, we have the trading book and the banking book. So if you are working in a bank, it's important for you to know what is the trading book and what is the banking book. So trading book contains assets held for short-term trading purposes to profit from price fluctuation. This is the definition that you can see here. So that is the purpose of your trading book. While banking book will have things which are for longer term, okay, which are kept by bank. Okay. Now, what is the objective of the trading book? Profit from short-term market movements. That is why we have a trading book. It is meant to generate a steady cash flow for long term. Okay, so that's the purpose of your banking book. As far as the risk exposure is concerned, okay, bank trading book have very high risk. Okay, obviously because of the reason that you have bought something with an intention to make money out of it. So if there is an unfavorable movement, you will make loss. While banking book is predominantly exposed to credit risk and liquidity risk. So for example, if you buy a corporate bond and you hold it till maturity, okay, then the corporate bond will be exposed to credit risk. The credit downgrade may happen, right? What are the types of instruments that fall under trading book? So your bonds, equity, derivatives, forex and all that. Here you will have loans, mortgages, deposits, held to maturity investments. Okay. This is the another segregation that we need to know. What is the context of valuation between trading and banking book? So mark to market is done in case of trading book, which means if you are making gains or losses, they will be accounted for periodically, maybe daily. Okay, and you get to know what is your gain or loss that you are having because of taking position in your trading book. Okay, it is done on historical cost or amortized cost method. Okay, and it is based on purchase price adjusted for interest and repayments. That is what is the context of your banking book. Capital requirement requires higher capital allocation under Basel III because of higher market risk. Okay, and you, since the risk is high, the price fluctuation may happen, you have to keep more capital. Here in case of banking book, the capital required is less. So this capital that we are referring to here is a capital which is a protection against risk and nothing else, correct? Liquidity, assets are highly liquid, easy to sell in active markets, okay, and assets are generally illiquid and have long-term maturity. That is why we defer to liquidity risk here, right? Because the assets are having long-term maturities and they are difficult to sell. Regulatory requirements focus on market risk fundamentals, which is your value at risk and stress testing. Okay, focus on credit risk framework, which will be more focused towards probability of default and loss given defaults and similar other aspects. Now that we have understood the difference between banking and trading book, let us move forward and see what are the types of market risk. So the first type is interest rate risk. So interest rate risk arises from the change in interest rate that can impact the bank's earnings and market value of its assets and liabilities. So you know that banks are in the business of lending and investments. Okay, they are also accepting deposits. So all three things, deposits, lending and investments, they are exposed to interest rate risk, right? On one side, an increase in interest rate may lead to higher borrowing cost, affecting profitability. On other side, interest rate increase may lead to lower valuation of loans, bonds portfolio of a bank. We know that there is an inverse relationship between the price of a bond and interest rate. So when interest rates go up, there is going to be an adverse impact on the value of assets that you hold, correct? An interest rate decrease may lead to lower interest receipts, thus lower profitability on floating rate instruments and loan portfolio of the bank. So this is the interest rate risk that we were referring to. Now banks often use hedging strategies such as interest rate swap, forward rate agreement, bond forward, interest rate futures, interest rate options, etc. to mitigate this risk. We are not discussing this in detail, but I'm just giving you a broader picture here. Now, when we talk about interest rate risk, this is split into 5 sub-segments, which are there. First is the pricing, then is the basis, then you have yield curve risk, option risk, and reinvestment risk. Now, while there is a description given for each one of them here, okay, we will look at specific examples to understand what exactly are these risks and how to, get a detailed understanding of these risks. So let us start with the first risk in the next slide, which is repricing risk. So repricing risk arises from the mismatch between timing of rate change of assets and liabilities. Okay, so this will be typically because the interest rate changes are not happening at the same time on assets and liabilities, and they are happening differently, right? It occurs when interest rates for assets liability do not reset simultaneously, resulting in leading to fluctuation in net interest income. So net interest income is one of the key source of earning for any bank. So if there is an interest rate change and there is a repricing, that repricing will have this effect. Let us see what happens. In India, a bank may have issued long-term home loans at fixed rate, but funded these loans from short-term maturity of 1 to 2 years of deposits, right? So what will happen if deposits rate increase due to RBI monetary tightening? The bank's cost of funding will increase, but loan will remain, or the income from the loan, home loan, will remain fixed, thereby reducing profitability. Now you can see that assets and liabilities are not getting repriced in the same manner, right? So because of which asset which is loan will continue to earn the same interest, but liability will have a higher cost, which is causing repricing risk. What are the key driver differences in the maturity repricing periods of assets and liabilities, which is anyway a feature of a bank. So banks have assets and liabilities of different maturities. Central bank rate change affecting funding cost and interest rate change due to demand and supply factors in the market. So this is what will be called as the repricing risk. I hope you were able to get this concept. Now the next concept is basis risk. What is the meaning of basis risk? Now, basis risk has also a context in derivatives, but here we are talking about basis risk in context of interest rates. So, basis risk occurs when interest rates on correlated financial instruments or liabilities change by different magnitude. This leads to mismatch in return and cost, impacting profitability. So, this example will clear this doubt. In India, a bank may have loans linked to MCLR while liabilities linked to repo rate. So what happens is that when you take a home loan, these days home loans are based on external benchmarks like repo. Okay. So when repo rates change, your home loan rates may change. They may either go up or go down. But what will happen is that the marginal cost of funding at which banks lend typically to large corporates do not change immediately, which will result into this basis risk. Okay, and we know that RBI has now made a change whereby external benchmark linked rates are used, like repo rates are used for lending. Many banks face back basis risk as legacy loans were still tied to MCLR or other internal benchmarks. So the benchmarking has changed, and that has caused this basis risk for the banks to stay in the system. What is the meaning of yield curve risk? Yield curve risk arises when the shape of yield curve changes, affecting the valuation of interest sensitive assets and liabilities. Okay, so during the period of economic uncertainty, yield curve can flatten or invert. It may become flat or it may become invert. For instance, long-term bonds may offer similar yields to short-term bonds, and this may result into yield curve risk. Typically, yield curve is upward sloping. So in yield curve risk, you may see all these situations. So this is the parallel movement in the yield curve, which means the yield is increasing or decreasing across maturities by same percentage, same value. Okay, we may have a situation when the yield curve gets flattened. This is the flattening of the yield curve. This was the initial yield curve, which has now got flattened, or there can be a steepening of the yield curve. Okay, so you may have a parallel shift, you may have a non-parallel shift. Okay, and you may also have a butterfly position which may get created, whereby you will reach a situation where your short-term and long-term yields are higher, but mid-term yields are lower. So that is the situation which is called as the positive butterfly. And this can be also a situation where short-term yields are lower, long-term yields are also lower, but mid-term yields are higher. This could be negative butterfly. So basically, yield curve risk arises because of multiple reasons which have been already listed out in this slide. So we have looked at three risks: basis, repricing, and yield curve risk. Now we have an option risk. What is the meaning of option risk? There are bonds which come with options, call and put option. So call option gives the issuer right to call back the bond before maturity. So the issuer calls back the bond before maturities. The subsequent cash flows, which is coupon, may not be received by the subscriber, and the effective return over a period of time may get reduced. This is what causes what we call as the option risk. So option risk arises because of the use of interest rate derivatives that contain embedded option, which are callable and prepayable loan. These options give borrower or investor certain rights that can affect the cash flow. That is the point that I just mentioned. Okay, because many times banks issue bonds at when the interest rates are high and later on call them back. The last risk in the interest rate risk is the reinvestment risk. So what is the meaning of reinvestment risk? Whenever a bank invests in a bond, it may get coupon, example, and the coupon may not be reinvested at the rate of coupon. It may be reinvested at a different rate. So that will give rise to what is called as the reinvestment risk. So we can clearly see that we have basis risk, price risk, yield curve risk, option risk, and reinvestment risk. Those five risks are interest rate risk. So what are the other types of risk? Before that, let us look at the impact of interest rate risk. So banks' net interest income may be impacted, which we have seen. Economic value of equity will be impacted, which means when the net interest income goes down, the bank's equity value automatically goes down because bank is earning less, which will have impact on the value of its equity. There can be change in its investment portfolio value, which may go up or down depending upon the change in the interest rates. And customer behavior also will change because of interest rate risk, because it has been seen that many investors like to prepay their loans when the interest rates have gone up significantly because they don't want to take that risk of higher interest rates. Having said this, what are the key metrics that we need to understand for interest rate risk? So first is the economic value of equity. What does it mean? This metric measures the theoretical change in the net present value of bank's balance sheet excluding equity. Okay, it reflects how change in the interest rate affect overall value of a bank's equity under various stress scenarios. So that is the meaning of economic value of equity. So we know that assets minus liabilities are equities, or assets minus liability is equity. A bank has assets, a bank has liabilities. Both of them earn income for bank. Assets earn income for bank while liabilities result into payment of money. Correct? So as a result of this, what will happen is that bank's equity value will be impacted whenever there is a change in the interest rate, because banks may earn less on assets and pay more on liabilities, or vice versa, which will have an impact on economic value of equity. And then obviously there is an impact on net interest income, which we already know. So what is net interest income? Whatever income that a bank earns, okay, and what it pays as the interest on the liability. So it earns a certain income from assets and it pays certain money on liabilities. The difference of the two is net interest income, which will also undergo change. Now there is a trade-off, okay. One noticeable aspect of managing interest rate risk in the banking book, which is IRBBV, is the trade-off between delta EVE and delta NII. So what research indicates, so let us see what does this mean. Research indicates that while these metrics are interconnected, optimizing one can sometimes negatively impact the other. For instance, strategies that protect economic value of equity may not necessarily safeguard NII, leading banks to carefully balance their approaches based on their specific risk profiles and market conditions. Okay, so a bank has to always think between what has to be done about economic value of equity and net interest income. Okay, now we have discussed this. Now how do we measure the interest rate? Okay, so we can interest rate risk, we can use gap analysis. Okay, gap analysis measures mismatches between rate sensitive assets and liabilities. So what is the gap? You know, how much of rate sensitive asset you have and how much of rate sensitive liability you have. That is the difference that it will measure. Then we have duration analysis, which is sensitivity of bond or portfolio value to change in the interest rate. We have earnings at risk. Okay, how much short-term profitability will be impacted because of change in the interest rate. And economic value of equity, sorry, economic value at risk, which is nothing but impact on long-term equity due to rate shocks. So these are the factors that we'll consider for interest rate risk. Now we also have the second risk, which is called as the currency risk. Currency risk is called as the foreign exchange risk also, and it arises when the value of foreign exchange fluctuates, and we know that banks are dealers in the foreign exchange. Banks are market maker in the foreign exchange, so they buy and sell foreign exchange, because of which there can be a risk that may arise. So why will the risk arise? Because of volatility in foreign exchange market, cross-border trade, and external shocks, like what we are seeing now, you know, Russia-Ukraine conflict, Israel-Hamas issues, and also the tariff worries that we have internationally, which luckily has kind of cooled down a little bit now. Okay. So currency risk is of three types: transaction risk, translation risk, and economic risk. So transaction risk arises whenever there is a transaction which is done and there could be an impact on the cash flow as currency appreciates or depreciates. So if a currency's value appreciates, okay, then it impacts the exporters, okay, which means that if a currency is becoming stronger, exporter will earn less money in foreign exchange, right? So that's a transaction risk. Translation risk happens when, uh, you have business across the world and you are consolidating your books at one location by converting other countries' value of your transaction in one currency. So suppose there's a company based out of Europe which has transaction in US, Japan, Australia. So these countries have separate currencies. So what will happen is all the values other than European values will have to be converted into euro, which will cause the translation risk, which means suppose there is an business done in AUD, that AUD, which is Australian dollar, will have to be converted into euro, which is the currency for the Europe, right? So that may result into some kind of a loss or gain, right? And then we have economic risk, which will arise because of change in the value of market conditions. Okay, so translation, transaction, and economic risk called the currency. Currency risk can be measured through value at risk, which is the VAR concept. Okay, how much is the possible or potential loss which may be there? Scenario analysis, which may look at currency movements. Okay, and what kind of potential loss it will have, and sensitivity analysis. Okay, how is the change in the value of currency going to impact the value of transactions or portfolio? So this is what I wanted to take you through here in context of the market risk. In the market risk, we have discussed two things. One is the interest rate risk, and second is the currency risk. We also have equity price risk and commodity risk, which I have not elaborated in this video, but I will definitely take you through this in another video. I hope you found this video to be useful. Please do not forget to like this video and subscribe to this channel. Thank you.